I'm bullish into year end, but I'm a little less confident about how markets behave into election day. And not that I think we're going to have a huge drawdown. If we do have a big drawdown, I'd be buying that dip. But I also don't think we can make new highs and then see the market blast off after election day. So I'd rather sort of say things look a lot better after election day.
Bitcoin is the most sensitive asset when it comes to global liquidity. And so 83% of the time, Bitcoin moves with global liquidity. It's more than S&P or any other asset. And so if you look at not just the interest rate cuts, now M2 money supply is expanding, and also we have cuts going on in China and elsewhere. And so I think that Bitcoin ends up being a big winner whenever we get kind of cheap money flooding into the system. And it feels like we just went through this big regime change, right? We were tightening, everyone was trying to kind of drain liquidity from the system. Now we're going to go the other way. And so Bitcoin should be a big winner here for the next couple of months.
Tom Lee kicks off the discussion by addressing the Federal Reserve's recent decision to initiate an easing cycle, marking a shift in monetary policy. Historically, such easing has been a positive catalyst for the markets, especially 3 to 6 months after the decision. Lee cautions, however, that short-term market behavior is often unpredictable. The immediate aftermath of the Fed's decision could lead to a choppy September, a period of repositioning for investors as they navigate the impact of easing, combined with uncertainties surrounding the U.S. election. While Lee remains bullish in the long term, he emphasizes the challenge of making short-term investment decisions. Valuations are not particularly cheap, and the market has already made significant gains. Investors looking to pinpoint an ideal entry point may struggle in the immediate term, but could find more attractive opportunities 3 to 6 months down the road.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The Fed unleashed us on an easing cycle, and that's going to be positive. We know it's actually historically positive 3 months, 6 months out. But what stocks do in the next month is a bit of a coin flip, and I think that's what we're seeing because there's some repositioning that took place. And also we're now thinking about the 40 days into the election. In election years, the November, December rallies are pretty tremendous. And in fact, when markets are up more than 10% in the first half, you also get big rallies November, December, sort of choppy through September.
You think investors are sold on the idea that this economy is going to make it? It's going to make it through. The Fed's going to pull this off. Is any of what we've witnessed since Fed Day doubts about the bigger picture?
So far, so good. This Friday, we get core PCE, and hopefully that confirms inflation is no longer on the front burner. But I'd say one thing I've noticed is that the number of investors and professional money managers that think we're already in a recession is very high. And so I think the evidence just has to be better than expected, and I think those views shift back to soft land. I think there is a lot of upside in the foreseeable future, let's say 3-6 months out. But for someone to tactically say we need to pin a 6,000 target and then put money to work today, I think it's harder to make that case because valuations aren't on the cheaper end, and we've already had a fairly sizable move. So I'm not saying I'm like bearish right now, but to me, I'd have a lot more confidence saying 3-6 months out, things are attractive, especially things like margin debt, right? It actually decreased in August, meaning investors have been deleveraging. It hasn't gone anywhere for the last 4 months at a time when markets are rising. I'm bullish into year end, but I'm a little less confident about how markets behave into election day. And not that I think we're going to have a huge drawdown. If we do have a big drawdown, I'd be buying that dip. But I also don't think we can make new highs and then see the market blast off after election day. So I'd rather sort of say things look a lot better after election day.
Can we make new highs if tech doesn't resume its leadership role in anywhere close to the degree that it had?
As long as tech is a market perform. If tech actually declines, that's going to be hard for the rest of the S&P 500 to compensate. But what we've seen so far, including days like NVIDIA and Tesla recently, is that tech is actually holding its own, but other stocks are starting to show catalysts and signs of life.
Yeah. What about the broadening trade? I mean, you look at the Russell, your big call, of course. week to date's down more than 1%. Really hasn't done much at all. I kept hearing, hey, you got to wait till the Fed cuts. Then you go into the Russell. I don't know. What do you think?
Well, Russell had a big week last week. It's some profit taking now. But I think that there's, this is what bottoms look like. I don't think bottoms are straight up. I know in 2021, energy was bottoming, and it was also very choppy, but eventually made not only new highs, but then basically had a blistering gain in 2020, in the year following. So I think that's a multi-year start for the Russell. It feels choppy, but we're still near all-time highs, and there's a big fundamental case to own small cap. I think a bond investor is buying a bond for a different reason than buying an equity. Because an equity gives you not only inflation protection and benefit from falling yields, but also capital appreciation and positive surprise. Bonds rarely give you positive surprise. I think a bond investor someone should have some income with some capital upside there, but there are so many good opportunities. And, the fact that China has started to actually perform better and potentially broken out, that's, again, a breadth signal, because that's been a big drag for the last few years.
Oh, how about that? Do you feel like the move that happened in China this week's a game changer on how we should view what, the potential turn in their economy means for the overall markets? I mean, we've seen certain stocks get a nice boost, some of the luxury goods companies, right? LVMH, Estee Lauder, et cetera.
And the gaming stocks.
What about in the bigger picture?
It's hard to tell what's a trading rally versus a bottom for China. I spent some time talking to Mark Newton, our technical strategist. He thinks this is a bona fide breakout, and it is coming on the heels of not only stimulus, but in the face of unrelenting bad news for China. So to me, a rally on bad news is a sign that maybe the worst is already priced into China, and that means it could rally for a while.
One of the more intriguing aspects of Anthony Pompliano analysis revolves around Bitcoin and its correlation with global liquidity. Lee references a recent study by Lynn Alden and Sam Callahan, which highlights that Bitcoin is the most sensitive asset when it comes to changes in global liquidity, more so than even the S&P 500. With the Federal Reserve and central banks around the world loosening monetary policy and expanding money supplies, Bitcoin stands to benefit significantly. Bitcoin has thrived in environments of abundant liquidity, and Pompliano believes the cryptocurrency is poised for further gains as central banks shift from tightening to easing. He also notes that while some Bitcoin holders have begun to sell as prices rise, a large portion of Bitcoin, more than 50%, remains untouched, indicating strong long-term conviction among holders.
If we look at that Fed interest rate cut, Bitcoin is the best performing asset so far. Gold and oil futures are kind of second. There's a new study that just came out from Lynn Alden and Sam Callahan that said Bitcoin is the most sensitive asset when it comes to global liquidity. And so 83% of the time, Bitcoin moves with global liquidity. It's more than S&P or any other asset. And so if you look at not just the interest rate cuts, now M2 money supply is expanding, and also we have cuts going on in China and elsewhere. And so I think that Bitcoin ends up being a big winner whenever we get kind of cheap money flooding into the system. And it feels like we just went through this big regime change, right? We were tightening. Everyone was trying to kind of drain liquidity from the system. Now we're going to go the other way. And so Bitcoin should be a big winner here for the next couple of months. Yeah, so what's interesting is in bull markets, if you look on chain, basically, you go through a bear market, everyone buys up Bitcoin, they hold on real tight, they don't move it for a year or two, and then as you get into a bull market, price goes up, and there's kind of a clearing, people start to sell their Bitcoin into that bull market. We have started to see a little bit of selling of Bitcoin as we kind of broke over $60,000 earlier this year, but still more than 50% of all Bitcoin is being held, for over a year and not moving on chain, which I think is probably the best signal. I wouldn't put myself in the Bitcoin maximalist bucket. I think that I'm a monetary maximalist, and I think Bitcoin is a big winner there. I think stable coins have product market fit and are going to be very large. And then also, I do think that there's going to be a lot of other technologies that end up being valuable. Ethereum, for me, last year I sold all the Ethereum and I bought Solana instead. And I thought that, that asset and that network is just cheaper, it's faster, it's going to probably do better
because that becomes you think actually that becomes a true financial network? We keep talking about payments.
I don't necessarily think of it so much, in crypto, I think that there's two revolutions going on. There's a monetary revolution, trying to be money, and that's where you see Bitcoin and stable coins. And then there's a technology revolution. And, do you need a blockchain or do you not? That's up for debate in a bunch of different ways.
I'm kind of looking for a potential rotation that's similar to the 2002 to 2007 period. That was the last time where a lot of global capital was stuffed into U.S. markets. So strong dollar, highly valued equity markets, emerging markets struggling for a long period of time, and as the U.S. Encountered a recession and then they cut interest rates, it kind of softened the dollar, and then it caused this kind of virtuous cycle for emerging markets, and capital kind of came out of that, and they went on to have a very good several years. So I think that we have a similar market environment to like that period. This is the kind of the first rate cut in a while, which kind of opens that catalyst for that rotation. So I'm kind of looking to see if there's follow through with that or not. Emerging markets had been weak, starting really in the late 90s, because emerging markets have a lot of dollar-denominated debt. That's where they get a lot of their financing from, and it's often not even lent to them by the United States. It's lent to them by lenders around the world that accumulated dollars from all their surpluses of various capacities. They lend them to emerging markets, and if you imagine, like if you took out a house and your mortgage was in Swiss francs, and the Swiss franc doubled compared to the dollar, you'd be in financial problems with your house, and maybe you're getting cash flows on the house that are in dollars, but your liabilities just like doubled compared to dollars. And that's really what happens to emerging markets when they borrow in dollars, and then the dollar has a big, strong cycle compared to most other currencies. They get squeezed, their corporate sector, their government sector. And so that was happening throughout the 90s, particularly the late 90s. But when the US weakened in the early 2000s, that actually gave an opening for emerging markets to have a really strong period. And throughout the rest of that decade, like that kind of 2002 to 2007 period, the U.S. economy did go on to recover from that recession, but it wasn't like the leader strength-wise in the world. Basically, the BRICS. That's actually where that name came from. The BRICS. It was such a popular, powerful place for a while. All these different emerging markets. They were kind of the core drivers of the global economy for that decade. And eventually, global financial crisis, and eventually, in the 2010s, we entered another stronger dollar environment, and so emerging markets have been in kind of another pressured time frame for quite a while, and this is kind of the first opportunity in a while for that to potentially rotate. So we have to see if there's follow through.
As we move further into the fourth quarter of the year, investors must weigh the potential for continued volatility against the broader opportunities emerging across various sectors and asset classes. Whether it's small-cap stocks, emerging markets, or the growing role of Bitcoin in the financial system, Anthony Pompliano analysis suggests that the key to success will be patience and a willingness to embrace the long-term view. Stay tuned for more insights and updates on how these trends evolve in the months ahead.
Please like and subscribe my channel.